Hello, 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 hello. Good afternoon, early afternoon, maybe late good morning to you all. I hope everybody's doing good, or good evening, good middle of the evening, middle of the night. I don't know where you guys are tuning in from. But hello and welcome. My name is Jason. It's been a minute since we've done one of these live streams. Well, I guess it hasn't been a minute. It's been a little while. We were live for CPI. We were live for the jobs numbers. Those were interesting. But today is the most interesting day this week. That's for sure. Because it's FOMC day. And I hope everybody's excited for it. I don't know if I'm excited for it. I think I'm excited for it. But I also kind of have maybe a little bit of dread. Because things could go lots of different ways today. And tomorrow and the following day and so on. Thank you all for tuning in. I really appreciate it. We're going to be watching. You can see here just above my head, we've got Jerome dialed in. We're going to have him live with us in about an hour. But we are a mere 29 minutes away from receiving the most important FOMC announcement this week, that's for sure. And I'm very curious to know, as we're coming into the announcement, how you guys are feeling about it, what you're thinking, what you're expecting. I spent my entire morning this morning listening to think pieces. I tuned into Twitter Spaces. I tuned into live YouTube things, just like this one. I tried to absorb the maximum amount of opinion as I could absorb this morning because I want to feel like I know what to expect. And, there are a couple of things that I acquired, a couple of pieces of knowledge that I acquired over my time this morning listening to people who are much smarter than I am. And I think we should share some of those ideas that I absorbed this morning. So the first piece here, what's up, Jammin' Fletcher? How's it going? Hope you're doing good. Thank you so much for being here. We got a bunch of people here, so if you're just tuning in, please say hello. I'd love to say hello to you. I'd love to know where you're tuning in from. I'd love to know your bias. What are you thinking about? What are we going to do? What's the market going to do today? How's it going to react to FOMC? But essentially, what I gathered this morning, I went out into the woods and I listened to all of these things and I found little bits and pieces of information around and I put them in my basket and I brought them back here to my desk. And in my basket, I have a couple of pieces of information. And those main pieces of information, it sounds like the general consensus is this could go one of three ways. The first way is a 50 bips rate hike. And from all accounts, a 50 bips rate hike is a nothing burger. If you do not know what a nothing burger is, it means that the market will be relatively unaffected by a 50 bips rate hike. That's the first way that this could go. Certainly possible. It's not expected. This is the least likely outcome. The least likely expectation is a 50 bips rate hike. But if we get it, we figure that the market won't care. And it's probably pretty bullish. Market will go higher from here. The second, what's up, Beverly? What's up, Jimmy T? Good to have you guys here. Thank you for saying hello. Beverly from Arkansas. Cool. I'm in Colorado today. The second thing that could happen, or the second and the most likely, based off of everything that I've read and listened to and observed, is a 75 bips hike. This 75 bips hike, though, people are very unsure about how the market reacts. Because of the expectation of the 75 bips hike, and this has been relatively the expectation for some time, especially since last week when we got the below expected jobs numbers, the above expected retail sales numbers, and the hotter than expected CPI number. This was a nice little cauldron of allowing us to expect 75 bips. So the market is pretty much expecting 75 bips. And, you could argue that maybe it's kind of gotten priced in at this point. And maybe once that announcement comes, maybe we make a move to the upside. Now, the thing that I keep hearing about this morning, though, is 75 bips brings a move to the upside, but also that move corrects relatively quickly. Maybe not today, maybe not tomorrow, but relatively quickly. So that's idea number 2. Idea number 3 is 100 bips. And the odds of the 100 bips hike, they're not that good. I think it's like 26% chance, 25% chance, something like that. If that comes, it's pretty much unanimous. The market's going to take a dump and try and make a move towards the June lows. And we can kind of take a look at those here in just a moment. Hello, Ziv. Thank you for being here. What's up, Precise Strat? How are you, Bubba? Hope you're doing good. Glenda, how's it going? Chewy, what's up? Glad you guys are all here. It means a ton to me. Thank you so much for being here. And Precise Strat in particular, thank you for the kind words yesterday. Yesterday was a bit of a bummer of a trading day for me, so I appreciate the kind words from you, sir. What's up, Daniel? How's it going? Greetings from Colombia. Nice. How's it going in Colombia? What time is it there? Probably, like 5 p.m. or something like that? I don't know. Yeah, so the third idea is the 100 bips hike. This would be not so great for the markets, but it would be potentially better for inflation. So I don't know. It sounds like everybody's expecting 75. Everybody's expecting a pop off of 75, but ultimately that it's not going to make much of it's not going to give us really what we want if we're bullish on the market. 100 would maybe be the best in the long term for inflation, but it wouldn't be good for the market at all. So we're going to have to wait and see. We've got 23 minutes until the announcement comes out, and then we've got another half hour after that for Jerome. So I was thinking in the interim, we could kind of take a look at, first of all, what has happened in the markets the past couple of FOMC meetings. So I've got, or rather FOMC announcements, rate hike announcements. So I just threw these up on the SPY chart, and it's pretty much the same reaction across all of the indices. So we have the announcement on July 27th. This is just an hourly chart. And as you can see, the move, they liked the announcement July 27th. Big hourly candle that did retrace into the end of the day. Or rather into the next day's open. We had a nice retracement back to kind of where it broke out from, but ultimately it held and it bounced higher the following day. So another piece of this is folks were talking a lot about, it's not just important the reaction on the day of, but also let's consider what could happen tomorrow as well. So again, that's why I wanted to kind of look at this. So anyway, the last time they raised the rates, we had a bullish reaction. They faded it into the close, and then they ripped it into the open the next day. That is scenario A. That's the most recent scenario. We go back to June, and we see something pretty similar. We see a nice swift move off of the initial announcement, and then Jerome gets to talking, and we give back a lot of that move, about half of it, and then the next day we open gap down. And we did ultimately reclaim, and it did end up gaining back, at least for a short period of time there, but the following day was a big gap down. So that's kind of interesting. That's past two scenarios, we've really ripped on the announcement, and then we've pulled back kind of as soon as Jerome starts talking. Let's go to May here, and we see something very similar. We see an initial rip on the announcement. He gets to talking. And actually, on this one in May, it was pretty strong. We were strong into pretty much the end of the day. The next day opens, gap down, we trade lower. So I wanted to go back and look kind of on a bigger time frame and see the story. And so if we go to the daily here, here's the same days. And a couple of things kind of occurred to me. The first thing that occurred to me is that in May, we had just recently made a new low, kind of in the downtrend. If we're just looking at, relative to these lows here, we made a new low. We have the announcement. We get a nice little pop back up to those highs, and then we fail. The same is true here, right? We have these lows, we make a new low, we pop on the announcement, and we fade. Whereas in this particular scenario on July 27th, we hadn't just made a new low, we'd actually made a higher low, and we ended up getting a further continuation to the upside. So what we don't have here is, I guess in the near term, we do have a new low relative to the early September lows, but we don't have like a big long-term trend new low here. So that's kind of a little bit different, or that to me sets us up in a little bit different of a way than we were set up back in May and back in June. So maybe we're a little bit more like where we were in July right now than where we were in May or June. I don't know. I'm just speculating. I'm no different than anybody else. I'm speculating on the way things could be. I want to grab my sidebar here. In the sidebar, you can access all kinds of cool information on the TrendSpider platform. We've got analyst estimates, we've got seasonality, we've got insider trading, we've got smart checklists, we've got unusual options. So I wanted to take a quick look at specifically unusual options, and I also want to look at seasonality and just kind of get an idea of how do the indices tend to perform this time of year, and also what options wise, is there anything interesting coming across the tape today or maybe yesterday that might give us a bit of an idea of where the big boys are positioned. So I'm going to add an unusual options widget real quick, and then I'm also going to make this wide, and I'm going to add a seasonality widget real quick. And on SPY, on the unusual options side, I'm going to open this up and see what we see here. Now, this is a dot plot graph of all of the unusual options data that we have. So this is the past, I believe, 200 contracts that have come across the tape that are considered unusual options. These are larger than $25,000 orders. So these are bigger orders. One of the first ways that I analyze this is just, let's look at the color, right? Red is puts, green is calls. It is very clear without even looking into any of these orders, their size, their strike price, their expiration. It is wildly, wildly clear that generally speaking, the market is positioned to the downside here, right? You see way more red than you see green. The market is positioned to the downside. Now you can take and you can shuffle out data and choose kind of what you want to see here. So maybe in this particular case, what I'm specifically looking for is like, let's just look out a couple months. I'm just going to bring this out to December as far as the expiry or the strike price, or the expiry date rather. With premium, I want to see big lots. So I'm not so interested in $25,000 orders, for somebody managing tens of millions of dollars. $25,000 it's nothing. So I like to kind of filter, I kind of drag this thing slowly, starting around maybe $500,000 in premium because, it's that stuff's more sizable and it's just kind of more interesting to me. So on the $500,000 premium minimum, again, we still see the bearish bias. Looks like one trade for the 400 puts on SPY. Looks like this thing is expiring today. 1.5 million in premium. We've got 1.2 million in premium expiring today on the 390 puts, and we've got repeat hits on the 390 puts for November. That's 2 million in premium. On the same end, on the opposite side of the coin, you've got $400 calls expiring next week. 1.8 million premium. And then we've got some way out, kind of some leaps, some December leaps, 400 calls Looks like 700,000 in premium, and then you've got the 364 puts for about the same. This might be the same person buying both sides or selling both sides. Maybe it's a straddle. I don't really know. And then, if you don't want to filter it out this way, you can see every individual contract that comes through that's an unusual options order. And what I really like to do on these is I like to look for large open interest, meaning, I want to see the trade take up a lot of the open interest, because the more outside of the norm, open interest wise, the more I'm interested in it. Simple as that. So we like to scroll down. I like to see these big purple bars here. So like this one, 425% of the open interest. This is kind of a weird bet to some degree. These are the 400 calls expiring on Monday of next week. And this was the $1.5 million order, or $1.8 million order. So this is kind of an abnormally large bet for this particular contract. Kind of interesting. Somebody kind of betting on a quick pop, maybe. Don't know what their plan is for this, but interesting to see. And we'll scroll down and see if we see anything else. My guess is that might be, here's one that's kind of interesting. This one came in today. This is the 350 put. Wow, 350 put for September 26th expiry. This is $50,000 in premium, so much smaller bet here, but 216% of the open interest. So again, this is an out of the ordinary bet to make. Could be a hedge. Maybe it's the guy calling for the $400 calls with 1.8 million bucks. I don't know. Or girl. It could be a girl too. We don't know. So this is kind of what I look for when I'm thinking about options, unusual options in particular. When we go to seasonality, we've got seasonality for the past 30 years on SPY. On TrendSpider, you can break down seasonality by month, by week of the year, by day of the week, and by hour of the day. Think about that. You can really, really get specific with when does this stock tend to perform the best. In this particular case, we're just looking for essentially a green candle. A green candle on a month denotes positive performance, right? Put one in the win column. And a red candle would be a 0. So if you had a 50-50 over the past 30 years, or if you had a 50% seasonality over the past 30 years, that means half of the time it's green on the month and half of the time it's red on the month. So September is that. September is 50% seasonality. So half of the time red on the month, half of the time green on the month. Where are we at currently in September here? We are definitely red on the month. 2 down on the month, according to the strat philosophy there. And so, we are in that 50% quadrant where we're red on the month so far. To get this thing green on the month, we'd have to gain 393. It's certainly possible over the next couple of weeks, but we'll see. But what's more interesting is October, November, December, and how that looks, how the performance of the SPY tends to be in October, November, and December. Well, in October, 66% win rate. In November, it's a 76% win rate. In fact, November is the second strongest performing month of the year on the SPY over the past 30 years. So that's kind of interesting. Second strongest performing month. This month is essentially equally the weakest. September and June are the 2 weakest months of the year on the SPY over the past 30 years. There is the idea, there is a very, very basic philosophy that says, hey, buy something when it's seasonally weak and sell it when it's seasonally strong. So seasonality is working in our favor here on the SPY, right? If you're of that mindset, I want to buy the SPY when it's weak, I want to sell it when it's strong, it would make a lot of sense to be going long into the SPY here and then selling in November when it's seasonally really strong. Again, all of this could change this. I'm not necessarily suggesting this is what you should do. I'm just, trying to give you a little bit of outlook or a different ways to be thinking about positioning yourself as we come into this announcement today, which we're going to get in 10 minutes. There's a bunch of you guys here. A couple of folks have said hello. Let's see. Daniel, Johan, thank you for saying hello, Johan. Your message was redacted, so I don't know what you said, but hey. Chewy, you're saying USD. Yep, USD is ripping. We can take a quick look at UUP, and we can see what is going on there. Yeah, new highs on the month on UUP. And wow. So the reason why Chewy brings this up is, for everybody who doesn't know, there is generally a negative correlation between the US dollar and stocks. If the dollar is going up, stocks tend not to be going up. Stocks tend to go down. So a good way to gauge whether you should be buying stocks at any given time, at least in the recent history of the stock market, is watch the dollar. If the dollar is ripping, you want to be out of stocks. If the dollar is weak, you want to be in stocks. That makes a lot of sense. And it's very clear here. The dollar is making new highs. I want to say, at the very least, quite some years new highs. I don't know. I think maybe like 2007, 2006, the dollar was higher, but it's absolutely so strong right now. One of the strongest things you can own is the US dollar right now. So interesting to see that. David, what's up, man? It is almost time. We've got 9 minutes. I need like a countdown. I need like a little countdown clock here in the top left corner of my screen to have that counting down. Levi, so the announcement is in 9 minutes. We will get an initial market reaction, but the real reaction is going to be when Jerome speaks. As you can see here, just above me, I've got Jerome all queued up. I'm going to give him a jingle at 2:30 and tell him, hey, buddy, it's time. You can go on now. And then he's going to go on, and we'll hang out and listen to what he has to say. So real quick, though, while we're waiting, let's go to the Qs. Let's check out seasonality on the Qs. We're going to see something very, very similar. September and February, 2 weakest months of the year. 46% win rate in September, up to a 74% win rate in November. So again, the bias here, if you're just looking at seasonality, the bias here is it would be wise to be going long into November, going long now into November. Be interesting to see how it plays out. I'm not saying it's going to play out, right? We still have, it's a 74% win rate. It's not 100% win rate over the past 23 years. It's a 74% win rate. So there are some years when September is not, or rather when November is not strong. And there are some years when October is not strong. And there are some years when September is strong, right? Like it's 46%. So it's just another data point, just another way for us to kind of gauge expectations and be thinking about how we want to trade the action. On the unusual options side, same kind of vibe here from what I can tell, way more red than green. If we dig into the time, let's pull back to... let's go to January, or let's go to December of this year. Let's just look from now until December, and let's make the premium. Let's increase the premium. I mean, on the big premium side, there's a lot of positioning to the downside. There's a lot of bearish positioning here. It looks like the biggest order, the 290 puts for 1.3 million in premium, expiring October 21st. We're trading, what are we trading at? 290 right now. So one thing we have to think about too with this is we don't know if the person who did this transaction, we don't know if they were selling these lots or if they were buying these lots. So, sometimes you will see scenarios where you have huge amounts or huge put orders coming through the tape at very, very important lows, and then price corrects to the upside. And sometimes what that means is that somebody was selling those big orders, right? So it's something to consider. This may not be a bearish positioning. This may just be somebody selling these big put positions to somebody else or to, a lot of different people. It's something to consider. I can't speculate on, the why of these orders. I can only speculate on the fact that they exist. And it's very clear most of the positioning is bearish on the larger order side. And if we go and we look at unusual or rather open interest, kind of unusual open interest, here's something pretty interesting. The 272 call for expiry December 22nd. This probably is the same buyer, 500% of the open interest, or rather 300. Here's 500% of the open interest and 143. So they're like 1,000% of the open interest on between the 272 and the 274s. And let's see, the premium size, not huge premium. Looks like about $100,000 in premium across those three sweep orders there. But kind of interesting. These are deeply in the money. We're trading 290. These are for 274, 272. So again, use your reasoning for why they might be positioning in that way. Those are a couple months out though, so that's kind of interesting to see. We got 263 calls, 125% of the open interest, but just a $26,000 order, nothing big there. All right, so let's real quickly check out IWM. Want to know what's going on the indices. So if we go to IWM, same looks, guys. Same looks. September, weakest month of the year on the small caps is September since 2000. And strongest month of the year is November. So we are seasonally weak right now. This is very common. This weakness that we are experiencing is very common. And it's also quite common to see quite a bit of strength come out of September into November. Something to keep in the back of your mind if you have specific expectations going into this news today and, how it trades, how the markets trade over the coming sessions and weeks. Important to understand that seasonally we are seasonally weak right now, but we are on the heels of seasonally the strongest time of the year, specifically November. So very important. With that, we are going to dig in and see if we can't find, let me pop on Twitter here real quick so I can be up to date. What are y'all's expectations? Let's talk about this real quick. We got 3 minutes before the rate hike announcement. What are you guys thinking? Is anybody here? Again, like I said at the top of the show, everybody pretty much is unanimously saying 75 bips. Do any of you guys think it's going to be something different? Do you think we're going to get a surprise to the upside, to the downside? Do you think we're going to get more than 75 bips? Maybe 100 bips? Do you think we're going to get less, 50 bips? I'm also curious to know what you guys expect out of the market from here. I have some ideas about what I'd love to see, but who knows if we're going to get it. I'm going to pop over to the SPY. I'm going to throw on the 1 minute chart here so that we can dig in and watch this thing. Because we're definitely going to get a reaction here very, very shortly. 0.0 bips. Kevin. That is a bold statement, sir. I don't know if that's going to happen. Jammin, you say 100? You say 100. So the central banks are all pointing to 100, huh? Eric, I am flat, my guy. I am so flat. I got nothing. I'm just not willing to do it. I'm going to let things settle. Now, if we get a big, a super, super powerful move, if we get a super powerful move today and we test I'm talking way higher, we come up into this gap, 406, somewhere in there, then I might have some interest. If we get some crazy move. But otherwise, I think I'm gonna keep my foot off the gas for at least for now. Do I think we test June lows? Well, I think it depends on on not just the rate hike that we get, but also I think it really, really depends on Jerome's tone, how he speaks, what he says. We went over the data over the past 3 announcements, and it's very, very clear that when he speaks, it changes the direction of things. All right, so initial move is down. Let's see here. What's up, Jake? How's it going, man? Glad you're here. Thanks for being here, buddy. So we got an announcement, clearly. See, this is why I stayed out of it, because you just don't know what direction it's gonna go. $75 bips. All right, so we're at 75 bips to 3.25 versus 2.5 was our previous. Estimated was 3.25. This is exactly what the market expected. And the market is taking a dumpski. So now in lies the question, is it possible for Jerome to come in here and save this thing? Can he wield some magic, and can he save this thing? What's up, Javier? Thanks for being here, buddy. I'm doing really good. I hope you're doing well also. Good to see some of the TrendSpider team. Everybody, David is on the team TrendSpider, and of course, you guys all know Jake. Everybody knows Jake. Getting a little bit of a buyback here, and, you know, for all of my price action trading friends, pretty clear spot to find a bid right off of those lows from yesterday. Those pivot lows, they're holding for now. What's up, Joseph? How are you, man? Hope you're good. What's up, Pandas? Why would it dump on 75? Well, why not, man? Why not? I guess the idea is 75 enough to do to inflation what needs to be done to inflation? That could be the first piece of it. The second piece of it is there are a lot of folks out there that theorize that the first move is always wrong and you fade the first move. So this could be a fadeable opportunity here, right? Maybe this is an opportunity to take a long position. I don't know. You know, the consensus based on what I read and what I listened to and what I watched this morning was that Jerome was going to come out super hawkish. He was going to come out strong and potentially like on the fringe of aggressive with his wording. 75 bips is one thing, but then what he says about what to expect from them going forward, that's a whole different thing. And remember, markets trade based off of expectation, right? So maybe this is a fadeable first move. Maybe somebody knows that Jerome is going to come guns blazing at this press conference here in half an hour and in 27 minutes. And he's going to say some things that are going to, I don't know, that are going to rattle markets more than they just got rattled. It's really hard to say. Let me go to multi-chart view real quick. For anybody who is a TrendSpider user, if you have not yet, y'all, we got multi-chart view now. This is super, super dope. Loving multi-chart view. I'm going to just throw everything up here just so that we could see it. We'll go to QQ, or rather, IWM. And, well, let's see. What else should we watch? You guys want to watch anything in particular? A fourth name? I'll just throw the dollar up. And the dollar rips. Very, very interesting. So what do we see so far? Q's testing yesterday's session lows. Actually, this might be the start of the day. I'm sorry. Yeah, it's coming into yesterday's session lows. SPY about to lose yesterday's lows. Just lost them. Interesting. IWM a little bit stronger. What's up, Lori? Hope you're good. Haven't seen you in a sec. And again, the dollar. This is telling us everything we need to know, right, y'all? Dollar ripping here. Very interested to see where this goes into Jerome's talk. If you are hanging out, if you're hanging out here, hang out here for a little while because we got Jerome. He's coming up. We got him in 25 minutes here. So get yourselves some popcorn. Brew yourselves a coffee if if it's early in the morning and you're still trying to wake up. Get you a nice coffee, get you your breakfast or your lunch or your dinner. Plop it down at your desk. Hang out with me for a while. I cannot wait for Jerome to come on. Let's see. Jake, man, what are you thinking, man? I want to get you on talking. Let me see. Jake, would you want to come on and chat with me for a little while? If you're still around. EUR USD. Let's take a look at that. Dang. I remember last time I was in Europe, Euro was like $1.75 to the dollar. Now it's 98 cents. That is wild. And taking out this nice breakout level. Man. This thing only has really one more chance. This 96 level until we're coming down into like 87 cents. Wild. Yeah, I'm going to hit up Jake real quick and see if he'd want to come on and talk shop for a little bit. Let's see if he's around. Because Jake's got a good understanding of macro. We were hoping to have a bit of a macro expert come on and maybe talk to us a little bit about what we could expect kind of going forward over the months to come with hikes and things. But unfortunately, we were not able to. All right, so Jake is on a call right now, but he's going to come on after. Sweet. All right, so Jake's going to come up. He's going to hang out with us for a little bit. I'm going to give him a jingle once he's ready to go. I'm sorry, y'all. I'm just talking to Jake real quick. And we're getting this thing figured out. I'm going to have him come on. So how's everybody feeling? How are we doing? Why only 75 bips? That's a good question. I kind of wonder that myself. Nice buyback here across the indices. They made a new low, took out probably all the stops below yesterday's lows and have really fired it back here. A nice bounce. Nice tradable bounce if anybody took that. Hopefully somebody did. So now it's just kind of chill out and wait. The market's going to do what the market's going to do. But ultimately, everybody saw this coming. Like I said this morning, or like I said earlier when we got started, 75 bips was absolutely... I didn't hear a single person say 50 bips, and I really didn't hear anybody say 100 bips either. I heard 75 across the board. I don't know about you guys. Yeah, Jay, realistically speaking, what is 0.25% in the grand scheme of things? I don't know. Maybe it's more so just positioning. Maybe it's more so like, what does that say? If the market, if everybody is expecting 75 and then they hit you with 100, what does that say about the seriousness of inflation? What does that say about the seriousness of the Fed? That's something that I think about when I'm trying to rationalize the difference between a 0.25 percentage point, right? Like you said, 0.25 point or 0.25% is pretty marginal, but I think it's more about like what it says about everything, about inflation, about the Fed's positioning and so on, about the way that they see where we are right now. And I think you're definitely right. They certainly are trying to control things. They're trying to soften the blow, I guess. Or at least that's maybe what it seems like. Whether or not that's it, I don't know. Oh, Joseph, absolutely. Yeah, so look directly above me. Directly above me is the announcement website. So as soon as that goes live, I'm going to essentially turn that into my full screen and actually, I may not turn it into my full screen. I'll probably just leave it how it is so that we can watch how the market reacts. But I'll definitely have his voice turned up so everybody can hear it and watch it here on the stream. I know that's why y'all are here. You're not here to see me. You're not here to listen to me talk jivey about the markets. Y'all are here for Jerome. And that's cool. I'm here for Jerome too. I wouldn't be here if it weren't for Jerome today. No, it's easy to miss, actually. I'm with you, Joseph. I'm with you. All right, so while we're waiting for Jerome, let's do a couple of things here. The first thing that I want to do we have anybody who is not a TrendSpider user here? If we have anybody who is not a TrendSpider user here, and there are a lot of you here, so I know that there are some folks here that aren't TrendSpider users. Let's do this. Let's hook you guys up with a little something. Copying this, sending it over to you, Crabs. Man, come on. Crabs, take this coupon. This is 35% off any TrendSpider account of your choice for a full year. Take advantage of this. If you are not a TrendSpider user yet, but you are a trader, what are you waiting for, sir? Or ma'am? You might be a ma'am. I don't know. Next up, guys, I want to invite you all to our Discord. TrendSpider's got Discord. It's slowly growing. We've got a fun group of folks in there. They're sharing ideas, chart ideas, scan ideas, these sorts of things. We're also thinking about ways to expand the Discord. Maybe I'll go live from time to time quietly on the Discord and not do it on YouTube and make it a private thing. Maybe we'll have cool traders come on and quietly offer, some educational resources, how to trade their favorite setups, these sorts of things. We've got a lot in the plans for the Discord. It would serve you to join up and be there for, as we grow into that world. What else we got, y'all? Hold up. Let me see here. I got this for you. I'm hooking you guys up with all of the things. Market coming back into the lows. So a nice little bounce there, but not really any meat on the bone. Here is my calendar, y'all. This is going to link you to every time I'm live. We're talking about live charting shows that we do generally on Thursday nights. We are taking a break from those, but they're coming back. We've got a huge event coming up here at the beginning of October. Some killer guests on our big, huge macro event. I'm not going to give everything away, but Hugh Henney's on it. Spot Gamma's on it. Theta Warrior's on it. We've got a lot of cool people coming with some big macro views for into the end of the year. These are some stud traders. We're really, really psyched to get to talk to them and get their general consensus opinion on, what they expect for the markets here into the end of the year. So stoked for that event. We are working tirelessly on getting that event together. So that's why we're not going to be doing the Thursday live charting shows for a couple of weeks, but we'll be back to them. I don't know if you guys have been watching those or if you tune into those at all. Strongly recommend. They're awesome. What else we got here? Daniel Gomez, what time does Jerome speak? He speaks at 2:30 Eastern time, so 14 minutes. 14 minutes and counting. I wonder how he's feeling right now. I wonder if he's nervous. I wonder if he doesn't care. Awesome, Brian. Thank you so much for the kind words. So glad you're enjoying the TrendSpider platform. It's a great thing to hear. Kevin, you did get the first 0 right. You got the 0 and you got the decimal point. So that's like half the battle, isn't it? He always sounds nervous. I mean, like I said, everybody's saying he's going to come out guns blazing hawkish, like powerful hawkish. That is the consensus on the street, is that he's going to be a hound dog today. So it'll be interesting to see if that's actually how it ends up playing out. I was kind of the mindset, like, everybody thinks 75. It was so consensual that I almost expected them to do 100, which is half of why I did not position myself in any way, shape, or form. Because I just said, man, if the consensus is wrong and they go bigger than everybody expects, that's going to be scary. And I didn't want to risk it. But again, he could come in and it's possible, he could change the whole scope of this thing. So let's do this. I'm going to switch to the daily here real quick, just so we can kind of take a look at where we are on the daily. So we are taking out the weekly lows currently across the board. Looks like, yep, the Qs took out the weekly low. The IWM took out the weekly low. The SPY took out the weekly low. Dollar's making a new high. Consensual. Is that, does it work? Does the word work in that context? I kind of felt weird saying it. Nice, Lori. Lori's short the SPY and she's green. I'm with it. Good job, Lori. Proud of you. How is everybody positioned? Were you guys positioned? I'm really curious. Mark, let's see here. Discord, you can only be in so many places. Guess because a former TrendSpider user didn't get advertised discount a few weeks ago. I know. Yeah. So you were a user, Mark, and you left and you came back. Is that what's going on? SQQQ, I'm sure it has been working. Huh. Is there anything that's working right now? Anything that's strong right now? Walmart is up. I'm just looking at like my watch list. Walmart is up. Wolf is up. AMD's up. Bitcoin is up just a little bit on the day. Target is up. NVDA is up, yeah. Mark, maybe we can try and help you out, buddy. James, is this James from Team TrendSpider? James? Old Blue Jay? Let's see if this is, I'm not sure if this is James Chambers, but if it is, maybe he can help us. Mark. EE. Oh, this is a new name. Accelerate Energy. Okay. Yeah, Wolf has been a mover for some weeks here. A lot of people. There you go. Mark, James is going to hook you up. We appreciate your returning to TrendSpider as a customer. James is going to hook you up. James is on the customer support team. He's going to help you out. So, Mark, hit up James. And you can do that by clicking this Contact Us button. So this is something I want to talk about real quick because we don't talk about it enough. I try to talk about it as much as possible, but it's something that I think maybe a lot of people don't realize about TrendSpider. TrendSpider has a team of people live every single day that's available to you, answering questions, teaching one-on-ones. We have a whole team of folks. You can reach them via the Contact Us button. Hit them up. Ask them any questions you got. They could be questions about the platform. They could be questions about an indicator. They could be questions about writing scripts, backtesting, scanning, whatever it is. If you need help understanding the TrendSpider platform, take advantage of the live team that we have. 7 days a week, these guys are here. On Monday through Friday, they're around for about 20 hours a day. On the weekends, it's about 8 hours per day, but there's almost always someone around who can answer a question for you. So take advantage of them. They are there to help you out, to make you feel more comfortable on the platform, to get you schooled up, and to answer any questions that you have. Hit them up via that Contact Us button. Jake just hit me up. So let's see what's going on with Jake. Oh no, Discord's not working for him. Bummer. Maybe we can try. Albert, we do absolutely. Yeah, you can get a deal if you are a currently enrolled student. You just have to sign up using your student email. Easy peasy. Joseph, hooking it up. What's up, man? Glad to hear that. I wonder if I can get Jake to give me a call. So it seems that his Discord's not working. Let's see. Jake, what's up, man? All right, hold on one second. Let me get my music turned down here. And let me get you turned up, sir. Jake.
Alrighty.
All right, hold on. Here we go. We're making our way there. Slowly but surely. All right, Jake. You there?
Yes, sir.
Can everybody hear Jake? If you can hear Jake, please please let us know in the chat that you can hear him.
Can you hear me?
I can hear you great. And it looks like your audio's coming through. It looks like your audio's coming through on my end. Okay, everybody can hear you. All right, sweet. So, Jake, give us your thoughts, bro.
Yes, sir.
How you feeling? How are you feeling about this announcement? Where's your head at?
Yeah, I mean, I think the market was kind of anticipating this 75 bips, and at least from my experience, watching price action, occur after the initial announcement, a lot of the time you'll get a reversal once he actually comes on and starts speaking, which I think is at 2:30 Eastern, which is in like 5 minutes.
Yep.
I've actually been on calls all morning, so I really haven't been able to focus on really up-to-date info. So if you have any more, but I think he is jumping on here in 5 minutes. I think that's what's really going to move the market. I'm not sure if I can share my screen on here, but
so share your screen with me, and let's see. This is going to be a new procedure for me, but we're going to try and make this happen. I'm going to try and figure this out here in real time. If I get this wrong, you guys, I'm really sorry. I'm trying. This is an unexpected this was an unexpected development.
Get our link up. Can you guys see my?
So I got your chart. Give me 1 second to pull this together. So we want this. All right, you guys, bear with me now. Bear with me.
Much better. You're much better live than I was, because I wouldn't know what to do there. So.
I mean, I'm figuring it out as I go. I'm not gonna lie to you. Parker's over here, like probably banging his head against the desk, going, "Dang it, Jason." But let me see here. All right, display. Okay, window. So I've got this, and then I need to add one more window capture. Okie dokie. Bear with me, y'all. Bear with me. We're getting this thing figured out, though. We're getting it figured out. View the screen. Let's see. Oh, nope, that's not what I wanted to do. Hold on. Let's see here. Y'all bear with me. I apologize. I'm still learning. Jerome hasn't gone on yet. We got 3 minutes till Jerome goes on. Let me see here. Okay, we got that. And then I want to do... No. Let's do this. I have an idea. Yeah. I'm going to do this. There we go. All right. Sweet. I figured it out. Boom.
Do you have it?
Yep. I got your charts up. And I got Jerome. We're good to go. Hit me.
Can they see my chart though?
They sure can.
Oh, hey, there we go. Let's go. All right. Well, I'm just gonna post real quick that we're gonna be talking. All right. Okay, we got the charts up, and let's kind of dive into it. We're on SPY. So SPY is going to be a little different than maybe the Qs, mainly because you've got this gap from July 15th. That is really kind of the main thing I've been focused on. Interestingly enough, it's already filled on the Qs. It hasn't filled on SPY yet. And a lot of the time you'll see here, even how price actions acted today, these gaps generally act initially, at least, as either support or resistance areas. So you can see here, when we did get the initial reaction, we kind of bounced right off the top of this gap. If I zoom in a little bit, you can see that we did actually start to fill it a little bit. But kind of going back to what I mentioned, a lot of the time, the initial reaction is kind of opposite of what we get a few days later, even into the afternoon after Powell actually speaks. And, before Powell, when Yellen spoke, very similar. You generally get kind of this reverse response. So if we absolutely started to rip to the upside, I'd be a little cautious. Now, I don't know what's going to happen. If anyone's telling you right now what they know is going to happen, they're just lying. Nobody knows what's going to happen here. But we can go back and talk about what's happened in the past, which is generally get those reversals. Now, I would like to see this gap fill, the 379 gap. I think that would be healthy, and especially since the Qs have already filled that gap. I think that's something to consider as well. That maybe SPY is just lagging that, but at the same time, all we can really do is just follow price action. But for now, it looks like we're kind of nearing those lows. But as as we get into this speech that he's about to do, or probably just started, that's really, I think, what's going to drive the market into the end of the day. So for now, your main gaps to watch are essentially your gap at 379.05, but then you've got this, like, I didn't even put it on the chart because it's so small, but you actually have another gap above that didn't fully fill from earlier this week. That fills right around 388.82. So we're pretty much trading within a pretty tight range between these two gaps. As you can see, the last 4 days we've been just trading within this area. So
Jake, we got Jerome on, bro.
I don't know. Sustained period of strong labor market conditions that benefit all.
Yeah. So
today, the FOMC raised its policy interest rate by 0.75 of a percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%.
And this is kind of that point
In
where
addition, we are continuing the process of significantly reducing the size of our balance sheet.
It's fiber optic cables
I will have more
and
to
their
say about today's
algorithms,
monetary
looking
policy
for
actions after
specific
briefly
words
reviewing
that
the
he's saying at this point. So that's kind of what's happening right now. You're
The
kind
U.S.
of getting
economy
that.
has slowed from the historically
The
high
market's
growth
trying
rates
to
of
digest what he's
2021,
saying
which
real
reflected the
time.
reopening of the economy
And
following
a lot of
the
that
pandemic
is
recession.
a lot of that's
Recent
really not
indicators
retail.
point
Right
to
now, you've
modest
got a
growth
lot
of
of these
spending and
just big
production.
firms, as I mentioned, with their fiber
Growth in
optic
consumer
cables,
spending
trying to be
has
as close
slowed
to
from
the
last
exchange as
year's
possible
rapid
to
pace,
get this
in part
information and then
reflecting
trade
lower
on it
real
quicker
disposable
than
income
somebody
and
else in
tighter
literally
financial conditions.
microseconds.
Right.
And that's
in the
kind of
housing
what I think we're going to
sector
see
has
during
weakened
this speech.
significantly,
Now, once he's
in
done, I
large
think
part
that's when you're
reflecting higher
going
mortgage
to
rates.
probably get some type
Higher
of
interest rates and
direction.
slower output growth also appear
But
to
for
be
now, you can
weighing
see
on
we're on the
business
10-minute
fixed
candle. We're
investment,
just kind of trading
while
within this
weaker
last
economic
30-minute
growth
range
abroad
here.
is restraining
And I
exports.
think until he probably starts
As shown
really
in our summary of economic projections,
insinuating
since
some things,
June,
maybe like
FOMC participants have marked down their
moves that
projections
they're
for
going to make.
economic activity,
I think
with
that's
the
what's
median
really going to
projection for real
drive
GDP growth standing at
the
just
market. So
0.2%
10-minute
this year
stuck
and 1.2%
daily
next
gives us a
year,
little better view
well below
here.
the
I mean,
median
we're
estimate
literally
of
just
the
trading in
longer
between
run
the two
normal
gaps.
growth rate. Despite the
I
slowdown
don't
in
like
growth,
guessing,
the labor market has remained
and I'm
extremely
going to
tight,
because
with
I
the
don't,
unemployment rate near
I
a
don't have a
50-year
position. I
low,
don't really care
job
right now.
vacancies near
For
historical
me, it
highs,
doesn't
and
make
wage
sense
growth
to even
elevated.
try to trade into these types
Job
of
gains
events.
have been robust,
You're
with
essentially
employee
really just
employment
gambling
rising by
unless
an
you
average
want
of
to take advantage of
378,000 jobs per month over the last 3 months.
like selling contracts
The labor
because the
market
implied
continues to
volatility
be out
gets
of balance,
really
with
spiked
demand for
up
workers
high around
substantially
this time
exceeding
of
the supply of available workers.
It's like
Hey, Jake,
earnings, right? I think a
Labor
lot of
force
people think
participation rate
earnings.
showed a welcome uptick
Hey, Jake,
in
let's
August,
listen to this real quick,
but
and
has
then we can
little
talk about it
changed
after.
since the beginning of the year.
Yeah, perfect.
FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term deflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched.
Market's coming back in now, huh?
The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people.
Seems like we're
My
kind of doing
colleagues and
exactly
I
what
are
usually
acutely
happens here. You
aware
get
that
your
high
initial
inflation
reaction, then the
imposes
opposite
significant
occurs.
hardship as it erodes purchasing power,
We're on
especially
each one
for
right
those
now,
least able to meet the higher costs of
which
essentials
is just the
like food, housing, and transportation.
I'm on the 1 minute chart. You can see, I mean, we've
We are
almost
highly
regained
attentive to the risks that
exactly
high inflation
probably
poses
about
to both
a
sides
little
of our
more than
mandate,
half of that.
and we are
that
strongly
initial
committed
move
to
down.
returning inflation to our 2%
So
objective.
it's these
At
days are
today's
really
meeting,
tough.
the committee
With
raised the
technicals,
target
all you
range
can
for the
do
federal
is
funds rate by
really
0.75
get
percentage point,
two
bringing the
sides,
target range
right?
to
Bull
3 to
and bear.
3.25%.
So for me, you know,
And we are
there's
continuing the
two
process of
sides
significantly
that
reducing the
prices is
size of
likely
our
gonna
balance
gravitate
sheet, which
to.
plays
That
an
is your
important
gap
role
above here
in
that
firming the
flows right
stance
around
of monetary policy.
389.
Over coming
And then your
months,
gap
we will be
below.
looking for
Right
compelling
now,
evidence
based on price
that inflation
action,
is moving
you've got
down,
this
consistent with
huge,
inflation returning to
outside bar
2%.
forming here on the daily
We
chart.
anticipate that
So pretty
ongoing
much
increases in
completely
the target range
erasing
for the federal
or
funds
pretty
rate will be
much
appropriate.
taking
The pace of those increases
out
will continue to
the high and
depend
the
on
low
the incoming
yesterday.
data
Um,
and the evolving outlook for the
So
economy.
yeah, I mean, if I were to take a random
With today's
guess,
action,
I
we
would
have raised
say,
interest
the
rates
market is
by 3 percentage
probably
points this
priced
year.
in a lot of this. I mean, look,
At some
from
point, as the stance of
September
monetary policy
12th
tightens further,
to
it will become
the low of
appropriate to
today, we were
slow the
down
pace of
7%
increases
in
while we assess
literally
how our cumulative policy
7 trading
adjustments
days.
are affecting the
So,
economy and inflation.
You know, that's
We will
definitely
continue
something
to make our
consider.
decisions meeting by meeting and
If I
communicate
were
our thinking
to
as
guess,
clearly
I would
as
say we're
possible.
probably going to fill that gap to the upside.
Restoring
Um,
price stability
you
will
just have a
likely
lot of people that
require
are bearish
maintaining
right
a
now.
restrictive policy stance for some
And
time.
generally, a lot of the time, the market
The historical record
humbles
cautions
people
strongly
and
against
kind of does
prematurely
what most
loosening
don't
policy.
expect.
As
So
shown in
you
the
know,
S&P,
I think
the median
I think
projection for
based
the
on the
appropriate
price
level
action,
of the
I'm
federal funds
gonna
rate
go and say
is
my target's gonna be that
4.4%
gap above
at the end of
before we
this
fill
year,
that gap below.
1 percentage point higher than
Right on.
projected in June.
Let's see what he says.
The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Hi, Chair Powell. Thank you for taking our questions. Gina Smiley from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular: to achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market.
Interesting.
So On the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Wow.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time you could see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now those will evolve over time, and I think we'll just have to see how that goes. There is a possibility certainly that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly today we've just moved, I think, probably into the very lowest level of what might be restrictive, and certainly in my view and in the view of the committee, there's a ways to go.
Rachel. Hi, Chair Powell. Rachel Siegel from The Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect. because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. And as I've said, there's no basis for complacency there. But to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say, how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, or rather increase in unemployment and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also, do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Just to follow up on one small thing, are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles, where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick.
Nick Timmeros of the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as
more pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know. You look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting, and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see, at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Howard.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby. Thank you. Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. So that's how we think about it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now and not something I expect to be considering in the near term. It's just, it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Neil. Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment and price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always take all of that, try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about, the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times, but really we're in very different situations. But I will tell you that our contact is more or less ongoing, and it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future, and indeed, Treasury rates moved up, so we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient, and does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong, but there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest-sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash, so there's a good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that, and that's a good thing because that means the economy will be more resistant to a significant downturn. But of course, we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. And you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike, thank you.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below-trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward-looking and the lags in your policy are forward-looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a slower. It's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this. Inflation, what we hear from people when we meet with them is that they really are suffering from inflation. And if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
Well, how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris Rugaber.
Thanks. Chris Rugaber, Associated Press. I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability, and you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of the rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that high inflation will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases, their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion, and this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment, and the way we do that is by slowing the economy. Hopefully, we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that, but none of that is guaranteed. In any case, our job is to deliver price stability. And I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So, I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Thank you for taking the question, Mr. Chairman. Edward Lawrence for Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down. And what you see in our projections today is that inflation moves down significantly over the course of next year, and then more the next year after that. And I think once you're on that path, that's a good thing, and things will start to feel better to people. They'll feel lower inflation. They'll feel that the economy's improving, and also if our projections are close to right, you will see that that the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs, and we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for another long period. This era has been noted for very long expansions. We've had 3 of the 4 longest in measured history since we got inflation under control, and that's not an accident. So when inflation is low and stable, you can have these 9, 10, 11, 10-year expansions, and you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
As a follow-up, what is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, down the road again, and doing it at a time when actually now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises, and so we want to avoid that. We want to act aggressively now and get this job done and keep at it until it's done.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week, and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset, and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country, where, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. There are also longer run issues though with the housing market, as you know, where it's difficult to find lots now close enough to cities and things like that. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
Shelter made up such a large part of this hot CPI report that we saw. Do you think that there is a lag and that we will see that come down in the coming months, or do you think that there's still this imbalance that needs to be addressed?
I think that shelter inflation is going to remain high for some time. We're looking for it to come down, but it's not exactly clear when that will happen. So it may take some time. So I think hope for the best, plan for the worst. So I think on shelter inflation, you've just got to assume that it's going to remain pretty high for a while.
Okay, we'll go to Jean for the last question. Hi, Jean Young with Market News. You've talked about the need to get real rates into positive territory, and you said earlier that policy is just moving into that territory now. So I'm curious, how restrictive is rates at 4.6% expected? Is that expected to be next year? How restrictive?
So I think if you look, when we get to, let's assume we do get to that level, which I think is likely, what you're going to do is you're going to adjust that for some forward looking measure of inflation. And, that could be, you pick your measure. It could be, there are all kinds of different things you could pick and you get. But what you'll get is a positive number. In all cases, you will get forward inflation expectations in the short term, I think, that are going to be, assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive federal funds rate at that point, which could be 1% or so. But I don't know exactly what it would be, but it would be significantly positive when we get to that level. And let me say, we've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook and ask ourselves whether our policy is in the right place as we go. Thank you very much.
Well, there you go, guys. That was a lot. That was a lot to take in. And I'm honestly not sure how I feel about it. He was pretty darn bearish, was kind of my take. Or maybe not bearish. Bearish isn't necessarily the right word. I think he sounds very, very committed to getting inflation down. Sounds like they're going to do everything that they have to do in order to get it down. And so now the question is how does the market care? Because in order for them to get it down, we're at what, 8.3 or something, and they're trying to get down to 2. Now, they did say 2025, so they've got time. I don't know. What are you guys thinking? Because I'm genuinely not sure. The market, initially, it was a nice response. We did make a new high relative to, what is this? I guess this isn't really today's open. We made a new high relative to the initial reaction low. So that's good. On a price action standpoint, it's what you want to see. We made a new high of day. But I don't know. In the long term, it sounds like they're going to do everything they have to do to bring inflation down, which means a continuation in the raising of the rates. It seems inevitable, right? So I guess that's where we stand, guys. We didn't get as big of a reaction as we initially kind of anticipated that we'd get. And when we looked at the dates or the past couple of FOMC days, it was a lot stronger of a move, both to the upside and back to the downside, than what we're seeing here. Now, we do have 45 minutes left in the day. Anything can happen. But I'm actually really kind of, the range that they're giving us here, they're really keeping it within range. Market expected it, it seems. For the most part, market expected it. We corrected back, and now we're essentially where we were before the announcement came out. This is not what we've seen the past couple of FOMC dates. So very interesting to see that just in general, just the fact that we didn't really get much of a reaction. It'll be interesting to see how it all plays out. What's up, Robert? You're late. You missed it. You missed the whole thing. But that's all right. Well, guys, I really appreciate you guys hanging out with me. Jake had to jump. But I really appreciate you guys spending the time to hang out with me. You guys could have been anywhere, but you were here with me watching it. So that means a lot, and I really do appreciate it. Real quick, before I get out of here, let me throw some things y'all's way just so that you have them. Again, I want to hook you guys up. If there are any non-TrendSpider users out here, I want to give you the opportunity to take advantage of a 35% discount. Here is the 35% discount. So please take advantage of it if you're interested in it. And really, that's all I've got to give you. Last piece, we have, let me see here, next Tuesday night, we have our next Twitter space. We do these every Tuesday night, trade ideas of the week space. Next Tuesday at 8 p.m. Eastern time, we're going to be hanging out with Kira Turner, Chicago Sean from All Star Charts, and Braxy. You guys know him on Twitter as Braxy. So we've got those three awesome traders on to give us their favorite trade ideas of the week next Tuesday night, 8 p.m. Eastern time. And that's it from us. So again, thank you so much for being here. Be safe out there. We don't really know how this price action is ultimately going to resolve. We'll be keeping our eyes on it. And yeah, if you guys need anything, if you have any questions about TrendSpider, do not hesitate to reach out to us via that contact us button in the bottom right-hand corner of your chart there. And as well, always feel welcomed to reach out to me on Twitter. My Twitter handle is, no, it's there. Yeah, it's right over there, at Krutzky Trades. I'm around. You're welcome to hit me up with any questions about the platform that you have. So feel free to do that. Again, thank you all so much for being here. I hope you have a great rest of your trading today. Trade them well and be good. We'll see you guys on Tuesday at 8 p.m. Eastern on Twitter Spaces. Sayonara.